Now, my subject is economics, and I thought I should tell you about a kind of economic theory that has been developing a great deal in recent years. Unfortunately, the lessons of this economics were not properly learned before the financial crisis, which I believe was in part caused by that lack. See what you think. I want to start with the idea that the economy, I want you to think of the whole economy, which is a lot of relationships between individuals. Now, all of these relationships are mediated by either contracts or what I will call regulations. Contracts may be very simple, like I will have these strawberries and I will pay you a certain amount of money for them. That's a contract that is fulfilled almost at once, very simple. And that, of course, is what we think of as an economic market. But that's not the only kind of contract. There are many other, much more complicated contracts, like many job contracts, most loans. Now, lending, the whole capital market, as it's called, is an immensely important part of the economy, and it really is not well understood if you think it is just like a free competitive market, the way that economists used to talk about them. And on top of that, you have all the economic relationships between people and government. That's what I'm calling regulations. That includes taxes and subsidies, and also a lot of quite direct control of economic action. Now I say what this has to do with incentives, because actually incentives is the topic that I'm discussing. Well, contracts give incentives. This may be obvious in the case of a simple contract for strawberries and money, where you exchange them. Just how many strawberries you're going to buy is influenced by what it will cost you. A low price gives you an incentive to buy a lot of strawberries, a high price, an incentive to try to economize in your consumption of strawberries. And that's, in a sense, all we mean by incentives. But you'll see that it gets much more interesting when we're dealing with more complicated contracts, or when we're dealing with regulations. Everybody knows that if you discuss taxes, you're going to be discussing incentives. If we say, why don't we do the sensible thing and tax the rich at 100% of their income, the answer is, well, that wouldn't give them much of an incentive to earn money that the government will succeed in observing. So incentives are quite central to deciding what kinds of regulations there should be. They're also central to deciding what kinds of contracts there should be in the capital market, in the labor market, in insurance. Now, the choice of contracts is going to be based on what kinds of incentives they create. At least the intelligent choice of contracts is going to be based on understanding these incentives. On top of that, you'd realize straight away that contracts themselves are chosen in the light of incentives. I'll give you a very important example of that during the talk, and so I won't go into it now. What is it that, as economists, we need to do here? Well, on the one hand, we should be explaining why contracts take the form they do. That's to say, we should be explaining what kinds of incentives are created in the world, and that's a difficult task. But it's always been part of economics to go beyond the task of explanation and to consider also whether in some ways it may be desirable to improve the design of contracts, to design better systems of incentives than the ones that arise in the world as it is. And I'm going to talk about both of these issues. But I'll start with what we call markets. Let's say contracts, ordinary exchange contracts in markets. What's special about them? Well, they're anonymous. That's to say that the trade that goes on between two people doesn't feel particularly personal. You're exchanging strawberries for money at the price that happens to rule in the market that day. If you went to another trader, another shop, you'd find the price for the same quality would be the same. So it really doesn't matter who is involved in the transaction on either side. That, of course, is only possible if it's perfectly clear what the quality of the strawberry is. Personality begins to matter as soon as you think, can I trust this particular shop to provide what it looks like? Well, of course, generally the answer is so-so. In fact, in a great many economic relationships, it actually is quite important who you're trading with. Now, a competitive market is one where you have a lot of people trading on either side of the market, buyers and sellers, and where you shouldn't have to put any effort, any cost to finding out more about people on either side of the market if you're trading there. That's what a competitive market is supposed to be. That's what it is in economic theory. And that's what it has to be if it's to be such a good thing as many economists have claimed markets are. So the free market ideal is the claim that you should really organize the economy with competitive, anonymous markets, where people trade with one another in a very abstract way at absolutely clear, simple terms of trade. But in fact, many contracts are not like that. They're often non-linear. The obvious example of this would be a loan contract. Now, when I talk about contracts, I don't necessarily only mean the things that are written down on a piece of paper that describes the contract. As soon as we talk about loans, we have to think about default. Not everyone who gets a loan succeeds in paying it back with interest when the time comes. In fact, quite a large proportion of loans are not fully paid back. That wouldn't have been written down in the contract particularly, but it's really there. It's part of the implicit contract of what is going on when it's set up. So what that means is if the circumstances of the borrower, the income from whatever sources, falls below a certain level, that in fact there will be default on the contract. The payment made by the borrower to the lender is not a linear function of the circumstances of the borrower, such as income. So it's non-linear, that's one aspect. And certainly not anonymous. Because in the case of most loans, it's a key matter to whom that loan is made. And it may actually be quite a key issue who is making it as well. But what I have in mind here, of course, is information. That the lender will surely have to acquire information about the borrower before deciding how much he's prepared to lend and on what terms. What he's going to charge, what the interest rate is going to be, what is the term of the loan. All of these things depend on getting information about the borrower. So I'm just giving one example. Here I list a whole range of things. It will be obvious to you they don't work like competitive markets. Insurance. Most kinds of insurance work very differently. I will discuss that in more detail immediately. Pensions, really not quite like that. What you get paid is not somehow or other the result of a simple trade like money for strawberries. Many employment contracts, all of these are personal, involve serious information about one or other or both parties to the deal. And it's a good thing, in fact, that it's like that. I'm going to go on to point out or to argue that indeed not all markets should be perfect competitive markets, and that ideal that had been laid down by economics for quite a long time is not really a correct ideal. So it's a good thing that not all markets are perfect. But we need to discuss just how well things work when they work the way they do in the real world, where, of course, markets are indeed not all perfect markets. The first example I'm going to take, I'm going to do so as to make as clear as I can what is this fundamental concept of moral hazard. This is the particular way in which information comes into understanding economic relationships. And I'm going to take the example of driver insurance, motor insurance. In the case of motor insurance, certainly in countries I have been in, there is typically what is called co-insurance. That is to say that the driver does not get full compensation from the insurance company when he has an accident and has to pay out money for it. Now, he doesn't get it, certainly in my country, because there's something called a no-claim bonus, which is a very strange way of doing this, by the way. But that means that further driving insurance in later years is going to cost more than the initial insurance, than it would have done before you had the accident. There may be other more complicated ways of doing things. Indeed, quite often the driver is allowed to agree that some part of the costs he would just pay without going to the insurance company at all. Why would something like that be brought into the contract? Well, as soon as you think about the incentives that are created by the driver insurance, you realize that there are important things here for the insurance company to think about. Whatever are the terms of the insurance, it's going to influence driving behavior. It would influence driving behavior. Maybe if it's somehow very expensive to have an accident, that will make drivers more careful. Well, you may think that's a little strange, but think of a very particular issue, which is how many miles are driven in the year. This is a dimension of careful driving, and it's probably the most important dimension of how you can be a more careful driver. If the measure of being careful is how likely you are to have an accident, or what's the expected cost of the accident, then of course the number of miles you drive is actually a very important variable there. So if it's very expensive to drive, for example, because you will on average have more accidents, and that will cost you more because your driving insurance is going to be more expensive, then that is a reason for you to consider driving less. The insurance company would ideally make you drive carefully, would ideally tell you you're only allowed to drive, say, 5,000 miles in a year, because that's a much more effective way of controlling the risk that is created by your behavior. The insurance company generally cannot do that. It's not that, in some sense, how far you drive is a totally private thing that couldn't be observed at all, but it's plainly very expensive for an insurance company to find out how much you drive. I'm not sure how this works for commercial driving, for lorries, because lorries generally do have instrumentation which shows how far they have driven, and I would suppose that the insurance companies should use that information, and the cost of the insurance should depend on that. But I can't be sure that that's been done, and I simply don't know. But the point I'm driving at here is that when something like driving care or distance is not observable, then you're designing the nature of the contract so as indirectly to influence that driving behavior by what people do. And it's because that behavior is not observable, that you cannot easily get information about it directly, that the form of the contract is not generally linear. It's not a straightforward relationship. And the most particular feature of this is that you cannot go out and buy contracts of the form that say, for every pound or ruble of accident loss, we, the insurance company, the other side of the contract, will pay you a certain amount. You can't go and buy as many of these little things as you like. It's not a competitive market. It doesn't work like that. Instead, you have to go to a particular insurance company and take out a contract, and the insurance company will make it a term, a condition of the contract, that you do not take out any driving insurance with any other insurance company at the same time. The reason for that is that if you could in fact make up your insurance by lots of little bits, you would get full insurance, and this would be insurance that would cover the sorts of costs you don't usually get paid, the trouble, the pain, the things that cannot be easily measured. And you would cease to have any incentive to drive carefully at all. And that's plainly not a good thing. It's not good for the profits of the insurance company, and it's just not good. Why do I say it's just not good? Because competition amongst insurance companies should bring down the profits that they make and make the insurance cheaper. So essentially, you should end up with a situation where everyone is getting their insurance more cheaply if they all drive more carefully. And that's why it benefits everybody who is being insured if the incentives are properly worked out. And there have to be incentives to act carefully. Now, as soon as I make this point, it will be clear to you that it applies in lots of other fields as well. And that's what we're going to talk about. But there's still something more to be said. Because what I've been claiming is that having these personal, non-anonymous contracts with co-insurance is a good thing because it gets the incentives better. But I'm not wanting to claim that it gets the incentives right. I don't want to claim that somehow or other this is the best way of running things. And I chose the example of driving insurance because it's a case where it is very easy to see how you could make things even better by something that isn't like a contract. It's not a supplementation. You can make things better here by having a tax on petrol. Because a tax on petrol reduces the number of miles that people drive. Well, maybe not all that much, but it does have an impact, and it's been checked empirically that this is true. When the price is higher, people on average drive less. And that, of course, reduces accidents. And it would make insurance more profitable, except that competition amongst insurance companies should mean that it leads to a reduction in the insurance premiums that drivers have to pay. So drivers will find themselves better off. Of course, they do have to pay more for their petrol, but and I'm not saying that an arbitrarily high petrol tax is desirable, but some level of tax is better than none for this reason. So we don't deal with these phenomena of the problem of information just by having ideal contracts. But this is a context in which probably the incentives on insurance companies to design the best contracts are about as good as you could hope. That they have this incentive because they can calculate the profits, they can get a lot of information about just how many accidents occur and what they cost and so on. They have the good statistical information and they can use it. Now, think of it in the context of pay for business executives or managers. Just how carefully they think out their business decisions is not directly observable, quite obviously. When the business executive has to make appointments of senior people in his company, he could take a lot of care over this. He could find out about a lot of people. He could spend a lot of effort in doing it. Or he could just rather quickly decide on the basis of a few people he happens to know. And one presumes that this makes quite a big difference. Well, if that's right, then we must be speaking of the same kind of situation as you have with driving insurance. That there's a question of what are the optimal incentives to provide. And this effectively applies to the whole area of investment and investment in development, which is why I put development in the title of this talk. Just as with the insurance case, which is pretty well understood in the insurance literature, we can produce models, economic models of this situation, and we can work out what the form of optimal pay would be. That's to say, how the pay of an executive, say the chief executive, should be related to the performance of the business during the year. Well, you won't be surprised to learn that you can get very different results depending on the particular assumptions you put in. I will tell you just a little about what kinds of results you get in the sort of circumstances where the effort the manager puts in, which is likely to be looking for characteristics of more and more projects before he narrows the choice down and says this is the one we will go for, but they're likely to push the probability distribution of profits up. That's to say, they're likely to make more profitable outcomes more likely and less profitable outcomes less likely. If that's the way that effort works, then under pretty plausible assumptions otherwise, you find that the pay schedule should have a low part where essentially it says if the outcome is pretty poor, then you should penalize the executive as much as possible. Now, if the executive is doing a lot of different things, and for example, you might reasonably divide up the various things that the executive has done, you might be able to identify the profits from different spheres of activity that he's done, then that might mean that you could have a large negative item in his pay check for certain aspects of his work. But very often, you just have to rely on total profits. And you may even, and you probably want to rely also on something like the change in the value of shares, which might indicate some information about future profitability. Well, if you do all that, what are the most severe penalties? There's obviously some low limit to this, and the most severe penalty is presumably to remove the executive from the job. A good many years ago now, I published a paper on executive pay, on the theory of what it should be like, and raised the question, why is it that people further up the hierarchy, top bosses, get paid much more, even more, than people low down the hierarchy? It actually didn't come out of the theory of supervising different levels very easily, and seemed a bit surprising. A couple of very good economists from Chicago came up with the answer that the reason for paying the top executive so much is that he has a lot to lose if he is observed to have performed badly. And that's the way of creating incentives that are large enough for the very important things that the chief executive is influencing. And I think in principle there's quite a lot of truth in that, although it can leave one a little puzzled that so often executives don't actually lose a lot when they lose the job. These severe penalties is something I'm going to come to shortly. But I want to raise a slightly different question now, which is whether the businesses, now, who's the business? The owner of the business, maybe. Maybe it's a small startup company. So it has an owner who's no doubt involved in the business and is an active executive and manager within the business. Does he have the right incentives to set pay schedules? No, by and large, he doesn't. Who might have just the right incentives to do it? Well, if there was a single shareholder, sort of at arm's length from the firm, not involved in the management of the firm at all, so that these pay schedules don't apply to him, then he would have the right incentives. And therefore, you may say, shareholders of a joint stock company, they all have the right incentives because they're all getting equal shares of the profits of the company. Actually, that's not quite right either, because you can, in principle, improve the incentives of companies by somehow arranging that when things go very well, that the total pay to the members of the company exceeds the total profits, and that when things go very badly, that they may be penalized even more. You may or may not want to do that, but it's a possibility that's not available if what is essentially being done is that the income, let's say the profit of the company, is divided between the people involved in it, including the shareholders. But shareholders are in a better position, and yet, because there are generally so many shareholders, they decide it's really not worth the trouble of trying to influence the pay system. It's easier to sell your shares if you don't like what the company is doing. And this has been a standard argument in economics for many years. So this is an area where we actually don't expect that things are set up right. And a very important case of this is the one I mentioned in advance when I said that one of the problems that gave rise to the financial crisis, along with some other problems, is one of these. CDOs, we, I think, all learned to recognize these letters, but didn't necessarily know quite what they were. They provided a kind of insurance against default risk. It's more complicated than that, because, of course, what happened was that banks, for example, who were lending for house purchase, had a lot of mortgages, would take these mortgage contracts and would split up the risk into high-risk part and a low-risk part. And then they would bundle these derived contracts together into CDOs, which is a rather complex derivative. Sufficiently complex that indeed I have met top bankers in Hong Kong who said that they simply didn't understand them. And they just accepted the advice of their more junior staff that these were things worth buying. Certainly, they were regarded as things worth selling by the bank. And what I want you to notice here particularly is that CDOs are marketed. That's to say, they are sold in markets effectively anonymously, bought and sold, and the effect of this is to practically give perfect insurance to the bank on the default risk. In other words, once the mortgage has been sold on, split up into different CDOs, there is no longer any advantage to the bank in having a very safe mortgage that will pay back as compared to one that isn't going to pay back. And this means, in principle, that in advance, when the agent of the bank is doing the loan, that he's not likely to have been given incentives to be careful about the borrower. Now, in principle, you would think that a lender is going to have to get a lot of information about the borrower and is going to try to avoid having one who will be bad at paying it back. He's going to construct a loan contract which will not be too large and will be relatively easy for the borrower to pay back. He will construct one that doesn't, for example, have low interest rates initially and high interest rates later. Well, all of these things didn't happen. Why not? Because the bank had no interest in encouraging its agents to be careful about making loans. It only had an incentive to encourage agents to make as many loans as possible, because then it would sell more CDOs. The existence of these things, the existence of a market in this context that tends to give full insurance, is exactly what one should not have. And we have a very clear example here, I think, of where the ideal of creating markets is a bad one. And bad one for society at large, of course. And there's a similar issue involved in the question of bailout, which everybody's been pretty interested in. And I will just mention that certainly what the banks did appears to be consistent with the belief that they were going to be bailed out. That's to say that they're really not too concerned if the financial situation of the bank becomes really bad. Why would they think that governments would bail them out? Because, of course, governments had bailed out similar institutions in the previous periods. Countries where that was not a situation, not a problem, seem to be countries where the banks were nationally owned, state-owned banks, and then the issue, of course, didn't arise. But how should bailouts have operated? Then I certainly think it would be a mistake to say there should have been no bailouts, because a lot of people would have suffered from that, small depositors and so on, and this doesn't seem to be good. On the face of it, you would say it should have come back to the incentives that the executives had. And I think what should have been built in to the bailouts was penalties, for example, losing jobs, penalties for the main executives who could be identified as having been responsible for these various decisions, like creating CDOs or buying them or selling them. Well, of course, it didn't happen, and in fact, famously, it didn't happen, and that's an interesting phenomenon. Time would not allow me to say very much about optimal pensions, but I wanted to make a point which I'm at risk of hiding by what I'd said before, that these are quite interesting mathematical problems of working out the optimal form of contract so as to give satisfactory incentives. They're not straightforward mathematical maximization problems. For example, you might be wanting to work out how to maximize profits. And then we say subject to some kind of issue. What is it subject to? Well, subject to people doing what it will pay them to do. That's to say, subject to the way that incentives are operating. You've got to find a way of describing what that constraint is, what it is for people to obey constraints. And this is it's not something you express in the form of an equation, like a derivative is equal to 0. Sometimes that'll work and sometimes it won't. And here is a problem where it actually won't work that way. And you get initially quite surprising results. It's something that Peter Diamond and I worked on some years ago. You may have noticed Peter got the Nobel Prize with Dale Mortensen and Chris Pissarides this year in economics. And we worked together on many topics. This was just one of them. And we looked at a population of identical people, and that's probably the appropriate model for thinking about what the structure of pensions should be. And we simplified our understanding of what was going on by supposing that people would, at some stage, become unable to go on working. I call this a model of intended labor supply. There are a lot of examples of intended labor supply. For example, I might decide one day how much work I intend to get done, whether I'm going to get a particular paper finished. And whether or not I do actually depends on when I fall asleep. If I fall asleep, I'm unable to continue completing the paper. And this is not something that can easily be made a subject of contract. Another similar case of intended labor supply would be introducing subsidies that relate to the number of children that people have. Because how many children a couple have, of course, may depend on biological constraints as well as on financial constraints or rewards. Anyway, we looked at the particular case that has to do with retirement and found that in a model of this kind that there is a maximum retirement age, probably rather a high one on plausible assumptions. I don't suppose that the French government is listening, or the French labor unions, but in that context one would certainly think that 62 was an incredibly low retirement age. But that pension contributions to the pension system should fall with age until they would reach 0 at that maximum retirement age. And that's very different from what you observe in any actual country. And this is an implication of the rather surprising rule that we discovered, which was that people should be made indifferent about the year at which they will retire. What makes the indifference? Well, of course, it's a question of the size of pension they will get and the size of contributions they will have to make. It's a calculation they have to do, and it comes out with these intriguing implications. Now, pension contracts and policies in practice don't look like this. You get quite low retirement ages, and you generally don't get as much of an increase of pension with age of retirement as this would imply. Why not? Well, maybe because the theory isn't easy enough. I said it's mathematically interesting, and so that might make you wonder how it's reasonable to expect people to respond properly to incentives. But of course, the other thing is that we don't know quite what we should do. And I just finish off because with this topic of imperfect rationality, everything I've said so far has actually implicitly assumed that people creating contracts, people responding to them, are perfectly rational. They can calculate the consequences of their actions perfectly well. And of course, everybody knows that can't really be right. It's a difficult thing to do, particularly in something like calculating your response to a particular pension contract or even a pay contract. This is something really quite complex. So I don't just mean that the calculation of the optimal contract is complex, that certainly is, but even the calculation of by the individual, the response to the contract, even that may be quite tricky. And anyway, it's hard to believe that people are perfectly rational. At the worst, we kind of expect people to, I mean, in these models, that wouldn't have been apparent so far, but in fact we're expecting people sometimes to work very hard just in order to avoid an extremely small probability of a very large penalty. It's not always like that, but they can be like that. This is absurd. We're exploiting the assumption of consumer rationality in ways that we should not. But the only way of getting away from this is by having a new theory that allows for limited rationality. This is something that economists and psychologists and so on are still trying to get the feel of and see where one can go. And I've been working on this. I think it's a major research area. So far, I would report that the results tend to be in the direction of saying you should limit the range of choice that people can make. And that, put it another way, implies the desirability often of quite severe regulation. Now, in something like government pension policy, actually nobody had particularly thought that the government should allow lots of options, other than an option as to the date at which you will choose to retire. And actually, I don't think that the theories imply that there should be a fixed, compulsory age of retirement. I think there should be quite a range of choice there. But in many spheres, I think it implies that one should try to devise the form of the contract that is likely to suit most people and insist that that's the way it should be. For example, with mortgage lending, this might say that the amount that you can borrow can only be a certain proportion of the current value of the property. It wouldn't surprise people if that were created as a regulation. But I think rather than this being something one can just wildly guess at, I think it's actually an implication of this kind of new economic theory that there should be restrictive regulation of that kind. Well, that's a quick sketch of a particular kind of information economics. Thank you very much. On the last question, no, I don't think they were wrong. It helped to explain things like the very high pay of General Motors executives who did not stay in their positions all that long. But of course, you're absolutely right on the main point you're raising. I mentioned cases like the recent crisis and the bailout of banks, where it looks as though you could apply these rules straightforwardly. But looking at it in terms of prospects, you're saying that actually a lot of what a businessman does will presumably have an impact on profits only in future years. In theory, the answer to this is that you will only actually pay the businessman anything when he retires, and presumably he has to go to insurance markets to get some money in advance of that. But this doesn't make sense. And it's actually, I think this is a serious research problem. It's not quite clear how far one can go. But on the face of it, there are cases where you'd think it makes sense pretty quickly to sack a man. And the interesting point is that you do this even although you presume that the poor profit outcome isn't necessarily because he was careless. It may just be because of bad luck. Because in fact, most investment decisions are very uncertain in their effects. And nevertheless, you put all this in to create the right incentives. And the old principle that you may execute a man to encourage the others, which is the joke the Dutch used at the expense of the British, there's a lot of truth in that, according to the theory. When you say how it's done, initially, of course, I'm simply, this is just a question of how bonuses should be calculated. And it's, I dare say, implicit in the theory that there should be explicit rules for the calculation of bonuses. Sorry, and the second question, this is the really... Quite, yeah. Well, which is a really big issue, yes. I was thinking when you raised the issue of social tension, that you were thinking that if we have payment rules that create a lot of inequality between those people who are lucky and those people who are unlucky in their fortune, that's likely to lead to social tensions. In other words, if this is regarded as a very general thing that applies to most people in society, that could create serious inequality. And I think one of the things I want to say on that is it's not just a question of whether there would then be serious social tensions, because I'm by no means entirely convinced that that's true, but I think it's extremely undesirable to have great inequality. And of course, I was thinking of cases where we're talking of people who are relatively well off in any case. And what I think the implications of these things is for a fair degree of inequality amongst the rich. Mind you, I didn't mention it explicitly, but you may have seen on the slide that one of the interesting features of many of these results is that there's an upper bound on the amount of pay that the manager should get. And that seems quite a general feature of a lot of models of this kind. So that at the upper end, you're rather squeezing things towards equality. And it's only at the lower end of these pay scales that you're getting it. But I certainly wouldn't be happy to recommend anything like this once we get into the main ranges of pay, where of course this is really not a proper description of what's going on. But it may be a more important issue than I allowed for, because it may be that the whole nature of industry is changing so much. You saw earlier how the size of the information part of the economy has become much greater. And that may be related with different kinds of jobs and the kinds of things where bonuses become more and more important. So there's clearly an element that we have to be quite concerned about here. In a way, it comes back to this issue of rationality, because I was thinking in terms of maximizing the average well-being of people, what we call the average utility. And that can sometimes be done by increasing inequality in order to create incentives. I'm afraid we have to recognize that is true, but I don't think it will take us to the extremes where social tension is likely to arise.
компания по вашему подходу возвратит мне хотя бы часть средств затраченных?
We need more like you, of course. And so that might be an argument. But no, of course not. You are paying the lowest amount, presumably, that you can have as a driver. I would still expect that anyone who is driving will have to pay something. But the interesting question is, are the insurance companies treating you all right? And this is the question of whether that assumption that I introduced, that there will be competition amongst insurance companies which will ensure that they only make a normal profit on the business, and that essentially you don't have to pay very much more than somehow they administer the expected damage that you might suffer in a year. I think that's okay. I'm sorry, for some reason the volume on the interpretation suddenly fell. I didn't. I'm sorry, it's. Good. Of course, derivatives as such are very linear. That's my objection to derivatives, that they are things that are bought and sold. So when I say it's linear, I mean that the total price you pay is proportional to the number of derivatives that you buy, derivatives of a particular kind. Of course, the structure of the derivative, the way it's put together, would be quite nonlinear in terms of the underlying risks. But that wasn't the kind of linearity that I was referring to. The linearity I was talking about is the relationship between the amount you pay and the number of items or the total items in this case that you buy. Whereas in many insurance contracts, where co-insurance comes in, for example, if you are reckoned to have need more insurance, for example, it's house insurance and the house is more valuable, that it's true in that area, they're quite often quite linear, but they may be non-linear as well, and that's the area where I was talking about linearity and non-linearity. So my objection to the derivatives was that it's not possible for your purchase or sale of the derivatives to relate non-linearly to what it costs. I think it's important to recognize that the answer is going to be different for different individuals. And that is actually the main point that Peter and I were trying to develop in our work on pensions. This is borne out by the statistics, where people do retire at very many different ages. And I suspect your question is more, if the government is going to lay down a retirement age, or if your employer is going to lay down a retirement age, should it be high or low? And I actually think that certainly a government pension system should essentially allow you to retire at almost any age up to a high maximum, but that the size of pension you get will be rather low if you have to retire at 50, and probably quite high if you retire at 80. Very important to bring in, to allow people a different experience in this case, which is actually what we've got, although it's not widely recognized.